Good, everyone. Welcome back to our latest Econ Talk. Gareth, we've seen a lot of changes happening in the interest rate settings across the country since the last Reserve Bank announcement in late November, which was actually to cut the official cash rate down to 2.25%. That was our expectation. Everyone thought they were going to do that cut. And they sort of signaled, look, they haven't got a particularly strong view on where things go next. They're not in the position they were a couple of months back, where they told us pretty clearly that things were going to continue to be cut, but they're also not saying that they're about to turn around anytime soon. The OCR track looking forward does have a little bit of a return back towards that 3% neutral zone towards the end of 26, actually more start of 2027 on their forecast. That's still a long time in the future. Now, despite that, you've started to see some pretty big reactions coming through from financial markets. I mean, what have we seen in recent times and what's driven all of that?
Yeah, I mean, financial markets had already ahead of the MPS been starting to think about when interest rates might start to rise again. But I think the projections and the tone of the Reserve Bank statement have made financial markets go, oh, okay, there's no more further cuts coming probably, which previously, markets were still thinking maybe 2% early 2026 for the OCR. Now that seems to be pretty much off the table. And so everyone's going, well, if that's not happening, then the next change is a lift. And when is that going to occur? And do we get excited about it? And my goodness, they do seem to have got excited about that, despite the fact that you say, I mean, the Reserve Bank essentially projecting through the rest of, or through 2026, that interest rates more or less stay where they are. Yes, there's a risk they start to rise later in the year, but it's not until well into the second half of 2026 that those rate rises look possible. Yet financial markets have gone, okay, this is where they're heading next. And so we have seen some of those wholesale rates lifting quite substantially over the last 2 or 3 weeks. And when you showed me a graph last week, I think it was, when we looked at it, I was like, wow, what is going on here? This is a really big movement. Have you done your maths right? But it does turn out that you have got those numbers right. And we've seen increases in the order of 30, 40, 50, maybe even getting up towards 60 basis points across some of those swap rates and some of the longer term ones as well, which is probably more surprising. You'd almost expect those to be a bit more stable, but they have taken off. It looks a little bit like there's some international stuff going on when you look at some of the international trends and interest rates, but still beyond that, very much a New Zealand centric story in terms of driving that. It's almost like we're going, okay, the worst is behind us. Inflation might be a problem going forward. We're going to have stronger growth as well. And so let's, to use a bad phrase, I suppose, almost get ahead of the curve. But the curve has got ahead of itself. That's kind of my interpretation. I mean, what have you been seeing through the numbers yourself?
Well, I mean, you're exactly right. You've seen a pretty big lift in those swap rates and what's happening sort of in terms of wholesale interest rates. Now, they do have a big influence on bank funding, but it's also been surprising to see just how much of a lift. I mean, you're right, towards, over some of the tenors, you've seen a sort of 50 basis point increase in where swap rates are sitting compared to the day before the official cash rate announcement, which is when things started to turn around quite materially. But again, that seems a little bit odd because you probably would have been expecting that in the future interest rates wouldn't have, continued to sort of hold at these record low levels. I mean, let's be quite clear here. We've been warning at Metrics at least that there was going to have to be a turnaround, not in a bad way, but just at some point you've got to return to normal after you take the defibrillator away from the sort of economic body, if you will. You shock it back into place and then sort of things return hopefully towards normal. There's been a lot of talk around sort of the missteps that have been occurring, but I agree. I actually think this is financial markets really overdoing it. I mean, even after that official cash rate announcement, you saw a bit of a shift in expectations as well in terms of the official cash rate for like you say, no more further cuts, so no shift down to 2%, but also sort of a feeling of okay, the increases might start to occur maybe late 2026 was where the markets were sitting. Over the last week or so, you've seen further economic data come out, including some good partials for GDP, which we'll see later in the week. And that sort of suggested that, there is a bit of a rebound going on. And markets have now moved their sort of picks forward for an official cash rate increase, a hike, to sort of mid next year, which is quite, I mean, 6 months in advance, right? And I think the worry, we're looking through that data, is that the improvement in GDP, yes, it's there, but it's sort of from a pretty dark place in the second quarter. So if we were saying 6 months ago that things were not necessarily looking particularly brighter, but not good, you've sort of gone into a bit of a hole. You might now have sort of clawed your way out of the hole. You're still not necessarily any better off than where you were 6 months ago. So I do worry about sort of how much things have changed around so quickly. But here's the interesting thing, in my view, is how everyone's responded to this. With something like a 30 to 50 basis point increase in your borrowing costs as a retail bank, I find it quite fascinating that so far you've only had one of the major banks that's changed. Westpac increased their 2 to 5 year interest rates by 30 basis points. Took them 2 weeks still after the official cash rate announcement to come through. So they were sort of, watching and waiting a little bit. They cut their 6 month rate because, of course, your 6 month rates have come down, your official cash rate's lower. No change to the 1 year and the 18 month. But still, now more than 3 weeks on, you've seen nothing from the rest of the other big banks who, I guess the question is, are they going to have to move soon, or are they just going to hide it, sort of wait it out? What's your sort of expectation there, Gareth? You've had a big funding cost increase. Is this sort of smoke and mirrors?
Well, it's interesting for me. I mean, of course, we're still in a position where the housing market is in a relatively soft state. We've seen sales kind of tracking sideways, prices. There's been a little bit of upward movement in some regions, but not uniformly across the country either. So I imagine from a bank point of view, they're looking at it and going, oh, we're hiking our fixed mortgage rates by 30 basis points going forward from here could well have an impact on the sort of demand for borrowing, and therefore, are we going to hit our lending targets that we've got in place? And so I think there's probably a reluctance from many of the banks to follow suit. Yes, they're having their margins squeezed at the moment in terms of what is going on, but they're also conscious that it is a soft market and they don't necessarily want to be dampening demand down anymore. Now, obviously, as a borrower, I could still go in at those sort of 1 year or 18-month rates that you mentioned where they haven't lifted, but you'd imagine that from a potential borrower's point of view, you're looking at it and going, oh, rates are starting to head back up again. I'm going to be cautious in terms of purchasing housing, in terms of committing to those major decisions, given that maybe I'd thought rates were going to stay lower through more into 2026 and through to the sort of second half of next year. So taking all that into account, yeah, I mean, look, it does surprise me that none of the other banks have followed. And I wonder how long they can sort of hold out, given what the margin squeeze that must be occurring. It is a bit of a quiet time over the next sort of 4 to 6 weeks for the housing market anyway. Over Christmas and summer, there's not as much activity occurring, but there could still be some pressure there if they continue to hold out. And so unless you do see those swap rates starting to moderate through in January, then you could well see the other banks having no choice but to lift at that stage.
And look, I think in all fairness, we also probably need to wait a couple more days to make a really continued firm assessment because of how much the swap rates and even the official cash rate sort of expectations have shifted the last couple of weeks, depending on not only how the GDP print comes at the later end of this week, but also how the revisions play out in terms of how we understand how the economy's moved. There's still potentially a fair amount of water to go under the bridge, potentially strengthening the signal that's been coming through, which is sooner rather than later and bigger rather than smaller. But equally, on the other side, you could see a bit of a muting of it. So a little bit, like I say, of sort of, water under the bridge still to come. But you're right, there is potential that everyone else is going to have to move at some point. You'd have to think sooner rather than later, but they certainly haven't for the moment. There is also, I think, a reasonable sort of concern a little bit there over how quickly that might start to then hit consumer confidence and spending appetites and similar. Again, people are still better off than where they were, say, 12 months ago in terms of their interest rate, but it does just start to psychologically stuff you up a bit as a consumer when you go, well, I thought I was going to have not quite as much of a mortgage payment, and now I've got more than I'd sort of locked in my head. So there is a bit of a risk there, although I do really think that, again, we had signalled some of this risk. Some of it does seem a little bit premature. I'm not quite sure what the Reserve Bank should have done, though. I'm reading quite a lot about the various missteps and the concerns and similar. I don't know if it would have actually been particularly right for the Reserve Bank to come out and say, look, markets, we don't actually think we're going to cut again, but just to make sure you don't overreact, we're going to tell you that maybe we'll ease a little bit more. That would be highly disingenuous for them to do something like that. And I feel like they played it with a pretty straight bat. They said, you know what, we just don't think there's a huge amount more in the system. We're going to keep watching the data. But at the moment, look, you broadly knew that we thought things were done, and now they probably are. I don't think that's particularly inconsistent, but I do think that there is a bit more of a sort of whipsaw that's gone through in terms of markets going, oh, the only way is down, and that's all we can concentrate on. And then as soon as that option got cut out, it was like, oh, well, the only way is up. Let's sort of, get a bit giddy over how quickly we can raise it up. Anyway, rant over on where the interest rates are. Like I said, still a lot of water to go under the bridge, right? There's still a lot that I think we're going to have to assess, but we are towards the end of the year, so a little bit of watching, waiting, and everything else over a summer break. We'll be back in 2026 with a bit more of an assessment of what interest rates have done, maybe what banks have done what, and also how we assess things. We'll cover GDP. That'll be the last thing that we crack through before the end of the year on one of our next editions of Econ Talks.